Welcome back. Well, let's welcome on board Varun Goel, the head of equity at Nippon India AIF, to discuss the market internals. Varun, hi. Thank you so much for making time and speaking with us. Well, how does the market setup look like at this point of time after the earnings season and the fact that most of the volatility and the uncertainty seems to be out in the first half? Do you expect second half to be much better for the markets?
Good afternoon. Thanks for having me on the show. I think if you look at the markets broadly, we are looking at 815 rupees of Nifty EPS for FY23. If you take a 12 to 15% kind of growth over this, we are looking at Nifty EPS somewhere between 910, 920 to 950. That's the kind of range. On that basis, market is clearly trading around 19.5, 20 times earnings, which is a slight premium to the 10-year average. So in our view, while the rest of the year Nifty might give a 5 to 10% return, but we do expect a lot of small and mid cap ideas, which were really beaten down last year because of commodity price issues and interest cost increases. Some of those names to start doing well. I think FY24 should be a great year for bottom-up stock picking with select ideas in banking, real estate, auto and capital goods space expected to do well.
Interesting. The one trend, Varun, that one is seeing today is the entire defense pack has been moving, very, very heavily. And many believe that, while there already have been some defense dedicated mutual funds which have been launched, more money from mutual funds is going to flow into the defense stocks. Do you also think that even after the run-up that they've already had, they still make for a good buy?
Well, I think defense as a manufacturing opportunity is going to be fairly large. I think the overall manufacturing opportunity, is going to be a fairly big one. I think what will happen is not just the OEM companies, which is some of these PSU names on the defense side, not just they will do well, but some of the ancillary suppliers to these names, where a lot of them come from the private sector side, should also start doing well. We remain also quite constructive on the various consumer durable EMS companies, companies which are getting more and more into auto, especially EV related component, EWS opportunity. So I think this whole make in India or the substitution of Chinese manufacturing into India is going to be a fairly large opportunity. Of course, one has to pick up names which are adding inherent value and not just assembling operations. And therefore, we believe there is a great opportunity to do bottom-up stock picking here.
Okay, great opportunity to bottom-up stock fishing. But is that the case for financials as well? Are you doing bottom fishing there or sticking with those large private names or the one or two marquee PSUs?
Well, I think it looks like we are largely at the end of the interest rate tightening cycle. So from our point of view, NBFCs should start doing well in the current environment, considering the fact that cost of funds is going to peak out soon. Our view is that the auto financing as a space continues to do well. The consumer finance should hopefully pick up as the discretionary incomes kind of move up during the second half of this year. So our view is not just tier one banks, both public and private, they will do well, but also a lot of mid cap opportunities around the vehicle finance space, around the home finance space should also start to do well.
Varun, you were talking about as to how defense is a good manufacturing play. Just in light of the Tatas now coming up with that factory for lithium-ion cells in the state of Gujarat and a capex as heavy as $1.5 billion, wanted to know, outside of defense, where within manufacturing do you find opportunities?
So we believe that auto as a space, will see a complete rethinking of the value chain. So what we are seeing is that as the IC engines get phased out, we will need a new set of vendors to come up and provide the components which are needed on the EV powertrain. So that's where we believe a lot of contract manufacturing will happen, and a lot of these companies which can cater to that should do well. Also, a lot of consumer durables, mobile phones, iPads, laptops, a lot of this this stuff which gets manufactured outside and is imported in India in very large quantities. Some of that should start getting replaced and substituted by companies in India. So that is where we believe a whole value chain or an ecosystem is getting developed. And I think third, one sector which we believe is going to be a very, very large export opportunity is chemicals. Now, last 1.5 years were very, very rough for the chemical sectors because the raw material prices went through the roof and there were demand issues as far as the European market is concerned. We believe FY24 onwards, we will see pressure being relieved on both the sides. Crude oil and various raw materials linked to that have already seen significant price correction. We also see demand getting recovered in the developed part of the world, be it Europe or US. And therefore, we expect a lot of chemical companies, especially the specialty chemical names, which went through a major earnings downgrade last year, should start seeing better times ahead. So we believe specialty chemicals, consumer durable EWS plays, defense-related, value chain players, all of them should see better times in the next 1 to 3 years.
Better time coming in for the pharma industry as well, because there are green shoots of some re-rating there. Are you already nibbling in and buying some of the pharma names?
We are quite positive on the domestic formulations space. The US generic opportunity, of course, looks like has structurally derated, and the kind of profitability that Indian companies had in the last decade might be difficult to come by. But I think the domestic formulation space continues to do quite well. I think the industry is growing at 10 to 12%. Those companies who can gain market share or be present in categories which are growing at a faster pace should do well. So that's the space where we would want to do some stock picking.
Okay, so that was about the pharma space. The other beaten down space, at least till a month ago, was IT, right? Is there any case to be made to look at that sector and do bottom fishing there, or maybe there are just better opportunities available, so not a great time to look at IT?
We remain quite positive on the whole mid-cap IT space. I think the whole view about investment in tech has changed globally with the advent of AI as a new technology and the driver of growth. And because of which, I think there is a rethink in terms of the kind of slowdown expectations which were there in US are now being revisited. Our sense is some of these mid-cap IT names in India should continue to grow at 15% plus kind of growth rates for the next few years. The valuations have meaningfully corrected in the last 18 months, and therefore we believe some of these names can be good 15 to 20% compounding stories for the next few years.
Just looking at some of the other movers in trade, and of course M&M is one right on top, a 4% move there. The stock has now climbed up the 1400 level on the futures. The Tata Motors, of course, going very strong. Maruti as well is in good gear today, 1.25% higher. L&T has been looking very strong. It's actually Axis within the banks, which is looking the strongest today off the pack. Almost a 3% move coming in here. And then, of course, there's IndusInd Bank and ICICI Bank, along with Reliance, which is also holding up nearly about 1% as we speak right now. Besides technology, Varun, what is your opinion on how pharma should be looked at? And do you think it's a contra bet which could do well? And besides pharma, which you've already given your opinion on, wanted to understand whether there are any other contra bets that you're looking at in this current market.
So we believe that the whole capex related stories, especially on the engineering side, should continue to do well, while the valuation multiples have already re-rated quite meaningfully. But we believe that the earnings growth will continue to come. We are looking at 15 to 18% kind of growth rate for this sector as a whole. And there's still a lot of stories, especially on the small and mid-cap side, which should surprise positively as far as earnings are concerned. We also remain quite positive on the residential real estate space. I think despite the pickup in the last 18 months, the affordability for resi space continues to be quite strong. The loan or the EMI to take-home salary ratio still hovers around 35-36% at the pan-India level, which is much lower than the historical peaks that we have seen around 45% plus. So we believe that key companies, metro-based residential real estate companies with clean balance sheets should continue to do well. Some of the building material players which will kind of benefit from the residential real estate recovery should also continue to do well. And I think pharma, while domestic pharma is definitely something that we are positive on, some of the API stories or companies which have a healthy order book and clear visibility of growth might do a lot better than the US generic-based companies.
Lastly, just wanted to get your take regarding the entire new age vertical, Zomato, Paytm, Nykaa, etc. Have you looked at any of these names positively?
So we have kind of stayed away from the theme for the last 1.5 years. Even now, while some of them seem to be inching closer to profitability, we need to see when the advertising spends go up, when the marketing spends go up, and when the next chasing of growth happens, will this profitability sustain, or we will still have pressure. So we will probably wait out a little more and see whether the arrival of profitability is really close, as is being expected.
Right. Okay, Varun, great to have you on the show. Let you go on that note. Good to speak with you as always. Let's just revisit.